What's up everyone, this is Kenny here from Property Stories. So today we're going to talk about some misconceptions when it comes to MRTA or MRTT, Mortgage Reducing Term Assurance. So to recap, what is MRTA? MRTA is actually a mortgage insurance, yeah. So mortgage insurance is the one that you take when you buy a house or property with the bank. The bank will ask you, do you need a mortgage insurance? This insurance will cover the loan in the event something happens to you, unforeseen circumstances, usually death and TPD. Usually this death and TPD, although different banks do have a different service provider and hence different types of coverage. So what are the misconceptions when it comes to this? The first misconception, get critical illness, no need to pay the insurance. Critical illness here referring to the 36 critical illness that you very often see when it comes to buying a life insurance policy. One example is they say, okay, this policy, right, if you get cancer, which is one of the 36 critical illness, you don't need to pay the policy already. The policy is free. You get to claim and the policy is free, no need to pay. Okay, that is life insurance. However, for MRTA, since it's covering the loan and this critical illness is not provided, you still have to continue servicing the loan. The loan is not free. The loan is not free. So that's one. Number two, I got two borrowers, so I buy MRTA, both of us are covered. That is wrong, ladies and gentlemen. If two person in the loan, but the MRTA buy doesn't mean it covers both people and doesn't mean it covers the same. You see, when you take a housing loan, right, if it's a joint housing loan, please ask the banker to give you a quote for how much you cover for yourself and your partner. Okay, whether it's your spouse or whether it's your parents or whoever it is that you join in with. Okay, so the MRTA policy, right, that the bankers quote you should have both your names, yourself and your partner. If only have one of your name, then only you is covered, not your partner. So in the event anything were to happen to you, your partner, you will have to service the loan. So please discuss with your banker. The third misconception, in the event of death or total permanent disability, I have MRTA, MRTA will cover in full. Wrong, ladies and gentlemen. A lot of times, you need to check how much is the sum assured, how much is your loan. Is it tally? For example, you take a loan of 35 years, but your MRTA only covers for 20 years. Do you think it covers fully in the event of death and total permanent disability happens to you? No, okay? The time doesn't even match. Okay, second one, the next example, even the time is matched, 35 years and 35 years example, you need to ask the banker how much the sum assured is. This is the sum assured that is going to be paid out in the event of anything unforeseen circumstances were to happen to the borrower. The banks will be able to provide you the sales illustration. When the policy inside, right, they have a sales illustration. You will see like yearly, right, how much you are being covered, and it goes down as years goes by. Okay. Number 4, after you finish the coverage, you cannot buy MRTA anymore. Not true. Okay, the banks is always welcoming for your business and also welcome you to help them manage the risk. If at the start you get a minimum coverage, example 10 years, then after 10 years you tell, I want to buy more MRTA, I want to cover fully this property since I still have another 20 years loan to go. You can just email the bank and say, I want to buy MRTA. No problem. The bank will be more than happy to get your business again and also to help them manage the risk. Okay? Of course, at that point of time, you are also 10 years older. You must remember that you will be subjected to medical checkup, maybe medical checkup or more stringent checkup for you to pass the MRTA. Then loading may even be imposed. So that time you have to weigh whether it's buying an MRTA is worth it or you should increase your life insurance. Number 5, MRTA is very expensive compared to conventional life insurance. Not true. MRTA here you cover only a few things, death and total permanent disability. It's not unlike where the conventional life insurance where you have riders, right, you can cover many things, critical illness, you can get a lot of savings plan. So the MRTA you pay, which is one-off upon your housing loan application, cannot be more expensive than your conventional life insurance that you pay monthly. You don't see it, but MRTA, you just pay one time, put into the loan, and even if you add interest as well, it will still be cheaper than what you are paying for the conventional life insurance. Because conventional life insurance is more flexible and it's more customizable, okay? That you can add many riders on it. MRTA is kind of dead. Once you set already, then that's it for the whole loan tenure, okay? So impossible, it will be more expensive than the conventional life insurance. This product, right, both of these products, MRTA and conventional life insurance, should complement each other. They are not supposed to compete. They're supposed to complement each other to fill in the gaps of your risk management. Where is a gap, it's supposed to come in via this insurance. Okay? So that's it for me. This is Kenny here from Property Stories. I'll see you again in the next video. Bye bye.